Welcome back to the YouTube channel. Today I got a super interesting topic to talk about, and this is going to be why I think that in fall we're going to be in a full-blown recession, and it's going to come even thicker than it is right now. So as you might heard of, there has been a lot of talking about student loan forgiveness, student loan deferment, student loans, everything that the federal government does. They said, it's gonna restart in fall. So it's been on pause for 3 years. And I'm hoping that 80% of people did not hope to just have those forgiven and kept the money that they were supposed to pay in a separate checking account and just didn't touch the money. Because whatever the government does, you know that, and I know that 3 words that are the most scary words in all of history, and I think Reagan said that I'm here from the government, I'm here to help. So I like that we're going to get rid of those student loans, and it really helped the economy out because there are so many people in the US that did not pay those for 3 years. So they used it at restaurants, they stimulated the economy, they did all this crazy stuff that they didn't have to pay. But now we're in harder times, interest rates are high. People are taking out more credit card debt. People are paying more for everything. And now on top of that, as Americans are struggling, we are now gonna re-pick up student loans coming up here pretty soon. So that means that we are going to have to pay more money to the federal government in form of student loans. So as you can see in this article, it's more than 3 years, and payments are going to resume pretty shortly. So Joe Biden wants to forgive $10,000 and up to $20,000 in federal student loan. I think it's a great idea to forgive it, but I don't think it's really fair for these people that did not go to college because they didn't want to take out loans. So people that went to college and took out loans because they thought it was the right thing, and they've went to college, took out a loan, have now a more high-paying job, is pretty interesting to me, because these people that were fearing of taking out those loans are now like, what the hell? I couldn't afford to go to college because the money-wise, not because they weren't smart, but just because they couldn't afford it and they didn't want to take out loans, are now in the same boat as these people that just went to college and said, oh, we're going to get it forgived. So that's going to come back and haunt, these new people that are going to take out loans, because now you're setting a precedent of, oh, we are going to forgive $10,000 to $20,000. So the first question that you need to ask yourself as a capitalist, as somebody in business, is, if the government needs to bail you out because you've taken out too much loans, why aren't we talking about the problem that education is too expensive, and we should take away the ability for people to lend money to students or colleges or private universities in the way that we have been doing it for a long time now? Because if it would be a free economy and it wouldn't be federally backed, then maybe when you're going to go into a degree that doesn't pay very well, you should probably not be able to take out tens of thousands of student loans. What do I mean by that? Well, I have this article pulled up right here that says 10 lowest paying majors when you graduate college. So one of them is hospitality and tourism. So if you're going to be in the tourism industry and you're going to be starting off, as you see the salary, this is from Indeed, by the way, so this is pretty reputable source for online. It's not just some hocus pocus random website, but this is actually pretty credible. So if you're going to go into the hospitality business and you're thinking about, I need to take out $20,000 in student loans, or 40, and the average for a bachelor's degree, I have it also pulled up here, is about $37,000. So if you're going to go into debt for the hospitality business, you need to make sure that your education system is going to pay down the road for that borrowed money. So it's funny because this topic really hits home for me, because Allison, when I got married to Allison and we got married, I asked her, hey, what's your debt situation like? And she said, oh, I have some credit card debt and I have 60 grand in student loans. And I was like, you have what? 60 grand in student loans? And she did. It's somewhere in the charts. I don't know if I can find it. I'll see if I can put it on the screen here. If not, I couldn't find it. But she had $60,000 in student loans. And that was before we got married. So I was like, holy smokes. We're going to have to tackle that. We're going to have to pay that down, because if we want to buy a house, that counts against us. So what did we do? Well, we rented a room from somebody. As a freshly married couple in the Bay Area, we've rented a room from somebody, and every spare dollar that we've had went into those student loans. So then we got married, and when we got married, instead of going on a $5,000, $6,000, $7,000 honeymoon, we went on a $500 honeymoon in Lake Tahoe, and we didn't even get the nicest place. And all that money that we got from our wedding, from that, was going towards student loans. So that really, really wasn't fun for us to have all that money that we got from the wedding, from all these people that loved us, from the job that she had, from my income. Everything went towards student loans. And so that really capped us, because we could have invested that money, we could have had other people help, we could have built businesses or did something, but no, we've had to combat that. And the way how the student loans get you is they'll give you, so you pay it over 20 years. That's how hers was set up. It was paying over 20 years, and it said you only have to make minimum payments, and every year it goes up by a little bit. So I looked at it and it's like, man, you had these student loans for 4 years and it actually went up. You didn't even pay them down too much. They actually went up. So it started off at $58,000 for her, and I've met her 3 years or 4 years afterwards, and they went up to 62 or something. So making minimum payments is really, really bad. But I see why people do it, because then you have more spare income and you can do whatever else you want. So I get that point of the equation. So with that said, that those student loans that we've paid off on, is I'm going to circle back around and I'm going to say that in fall, when these student loans are going to be due again, is that you're going to have to take all that money that people were now spending into the economy and helping small businesses, lifestyle-wise, travel-wise, that money's going to be sucked out of the economy again, because it's going to go to the federal government in form of payment. So that's really going to take away from your cash to actually do things that you want to do. So if you wanted to invest that in stocks, bonds, in your personal self, in cars, in assets, or whatever, you are now basically not able to do that anymore, because those repayments are going to start and come back and haunt you. So it is really, really important for you to either have that money set aside or have never stopped making payments. And when we look at the data from Indeed about low-paying job, arts and crafts majors, design makes $49,000 a year. Technology and religion makes $31,000 a year. Those degrees should not be able to take out $30,000, $40,000 in student loans. Those degrees, when you want to be a pastor and you need a bachelor's degree, you should be able to get a bachelor's degree in your field for $4,000, because your field just doesn't pay much. And the open market would never, no bank, real bank, would never allow you to take out that much money and loan it on something that they can't see a return on. So that said, is that you're going to take out the student loans and do something smarter with it, with the money that you're taking out. Because in this article, it also says that people took out more than they need to live comfortably. And I get that. You want to You want to enjoy college, you want to do all that stuff, but it was just not worth it. Because when I look at it, for a total of 45.3 million borrowers have student loan debt. That's crazy. That's crazy. When you look at that, and the pause is now coming to an end. So these people that bought cars that are overpriced and have a higher payment now. So let's say you bought a car 3 years ago or 4 years ago that was still running pretty decently and was pretty well off, and you spent $800-900 in payments. What was high, and now you have to start repaying your student loans. So where's that extra money going to come from? And I've seen articles now saying that, oh, people work 2 jobs now and they're still not getting ahead. And that is really dangerous for the economy, to have these millions and millions of people not reinvesting that money into the economy. So we're going to have a trickle-down effect of high interest rates. People have to repay their student loans, high car prices, and what is going to, according to your opinion, let me know in the comments below, what is going to come down first? Which sector is going to fail first? Because we're having so many failed banks, we're having failed food stores, we're having failed, McDonald's has closing locations, Burger King's closing locations, and grocery stores are closing down. So we're at a verge of something really, really bad. And I hate to be the doomsday guy that's like, oh my gosh, you're one of these guys that always does the doomsdays. No, but I know when I need to be really careful with my money. And so I'm actually back living on a budget because I think the economy is going to go really, really bad. And so do a bunch of other people. But I believe that in order to keep it rolling and keep it going, we need to come up with a creative solution how we can forgive those student loans or get them on a repayment plan from their employer that says, hey, employer, you now have somebody in your organization that owns federal student loans. We are going to pick up the tab for a part of it, and they'll take a part of it, but you need to pay us something. But now you're putting it back onto the employer. And I think with tax credits, you could probably find a pretty creative solution of saying like, hey, we're going to forgive that, but you need to hire a certain amount of people that have student loans or that are in that student loan bracket that you can forgive. But that's not fair to people that paid out of pocket. And I feel like people need to be accountable and stand up for what they did. So when you were 18, I think it's really dangerous for them to sign student loan papers that are really, really expensive. So if you sign as an 18-year-old for $100,000 in student loans, I don't think you grasp as an 18-year-old how expensive that money is to borrow. Because if you're not in a field, in a tech field, that's going to pay you a huge salary, you're going to be in trouble. So when you look at the money that you're spending right now and you need to take that into consideration, then you are going to be fine. But if not, it's going to be really, really hurtful if you're not going to have that spare income anymore. And the sun is burning. It's a gorgeous view, and I'm still getting my walk in. So yeah, if you're in the student loan bracket that's going to restart payment if you took out federal student loans, that is not good. And I get it, you lived 3 years without paying them, and now you're going to have to start redoing them. I'd be sweating. I'd really be sweating, because everything went up and it's not coming down anytime soon because supply and demand, right? They said, oh, the housing market's going to crash and it's going to afford the millennials and other generations after us to buy houses. But you were at a year and a half, we were right at a sweet spot where asset prices were high but not too high, and interest rates were kind of low. And so it would have been great if people would have refinanced their student loans in a low interest rate and locked that in. but I don't know the technicality, how that works, if that's something you can do, or if people did that, let me know in the comments below. But that's what I would have probably tried to do. And you can't bankrupt them, but now you're on the hook for all these overinflated prices. So that brings me to the next topic, cars again. I know I love talking about it, but if you bought a car, a Jeep Wagoneer just like this one, and you paid $100,000 over, no, you paid $100,000 for it because it was about 80 before they tacked on these crazy markups. So now you see them come down to, they're coming down 10% off or whatever it is off. So now all of a sudden you can buy that car for 50 that you bought a year and a half ago for 100. So what are you going to do? You're basically just going to walk away from it and say, let the bank handle it, and you're going to give that car back. But with student loans, you can't do that. So what are you going to do with your federal student loans that you can't pay for and that you don't want because you're just not bringing in the ROI that you were thinking of? So there's only a few options that you can do, and what I would do is I would see how I can get my income up, side hustle, delivering pizza, doing something. But it sucks that you're a highly educated person with a bachelor or a master's degree that is going to have to deliver pizza on their time out of work to pay for your student loans. And so that brings me to the next topic, the schools. So schools don't really care about the degree, they just want the student loans. So their customers aren't the students, it's the banks, because they're going to fund you and all these nice amenities that the college says, you know, like when you do your first tour, because I got a bachelor's degree and an AA in psychology, so I know how it is. And man, these flashy campuses, I went to UCF, this school right here, and the flashy campuses are really nice. But there's a news flash for you, you're gonna have to pay for that. So these campuses aren't free, and not all of them are subsidized by the government. So you, the student loan borrower, are paying for that. All these amenities that they have, the cool arts and crafts room, the cool basketball courts, these events that they're putting on, all these crazy things are paid for by you by taking out student loans. Yes, teachers get high salaries and all that other stuff. Maybe not in high school, but in college, they get high salaries. And you can, most of the states have transparency, so you can look up what your professor makes. And you can see they're making, in California, they're making 6 figures. And you're basically going there, paying their salaries, and the advice that they're giving isn't even accurate to what you're going to get in real life. So you need to be super alert in what kind of student loans you take out, if your field's going to pay. And you got to make sure that if you do take them out, that you're not going to be stuck with them, paying them for 15 years. Because the worst thing that's looming over your head is you can't buy a house because you got student loans. So now you're not buying a house, you're not living your best life because you got student loans. And I think there's going to be people retiring with student loans. So what are you going to do when you're going to have people that are retired with student loans? Well, how's that going to affect their retirement? So if you're a high income earner that makes $200,000 and has $500,000 in student loan debt, I'm not too worried about you, because you can just get roommates or downgrade the house and live in a studio apartment for a year or two and pay that off and get some side gig, get some coaching clients, or teach some other people some of your skills and make that money up. But for us, for me and Allison, we had to do exactly that. And I'm glad we did it in our late or mid-20s rather than now, because as you get older, you don't want to do as much. So right now we're in the 30s, and I'm like, let the younger version of me take care of the heavy lifting. And you got to be super careful and super worried about every dollar that you're spending, especially now. If we're going to come out of this in a year or so, it's going to look a lot different, because in a year from now, you can just refinance with a lower interest rate, do things, play around with that. But now with high interest rates, everything's expensive. So if I was there again, or I was about to go to college, name brand schools, not interested. Give me something that's paid for, like work at Starbucks and go to Arizona, stay online, take the minimum requirements, and get a degree online or something, because I'd rather not go to an Ivy League school and have no student loans than go to an Ivy League school and have a shit ton of student loan debt. And I think that's going to really handicap, I don't know, I'm not sure if you can say that, but it's really going to burden you for your future self, and your now is going to thank your future if you don't do that. So let me know what you think in the comments below, and I'll see you in the next one.